Options Foundation Series, Lesson 4, Option Chain Explained. Hello everyone, thank you for watching this lesson. My name is Bala, and I put this series together to teach those who are interested in learning options trading the right way. If you came to this video without watching the previous lessons in this series, I strongly recommend you go back and start from the beginning. Each lesson builds on the previous one. And if you are not already subscribed, please go ahead and like and subscribe to my channel, Net New Universe, so you don't miss the upcoming lessons. Today, we're diving into the option chain, the screen that looks confusing to most beginners. Using the Tasty Trade platform with Apple stock as our example, I'll show you how to turn this into a simple decision-making tool. 1. Ticker symbol. Ticker symbol. What it is? This is the asset that you are looking at, Apple stock. Why it matters. Every option price, delta, IV, and premium is derived from this. How traders use it confirms you're on the correct instrument needed for directional thesis. 2. Expiration date. Expiration date, Feb 20th, 2026. What it is, the exact date the contracts for this row expire, why it matters. This defines the time component of the option. How traders use it, choose trade duration, 0, DTE, intraday momentum, weeklies, short swings, monthlies, position trades time, premium value. 3. DTE. On days to expiration, DTE on 7D. What it is, number of days left for this expiration, why it matters. Controls, theta decay speed, gamma behavior, probability of move. How traders use it, scalpers, low DTE premium sellers, higher DTE, your system, align with expected move timing. 4. Bid price. Bid price. What it is, the highest price someone is willing to pay you for your call. Why it matters, this is your exit price when selling a long call. How traders use it, to close a long position, to evaluate spread, bid versus ask, liquidity check, you always sell at the bid. 5. Ask price. Ask price, what it is, the lowest price a seller is willing to accept. Why it matters, this is your entry price when buying a call. How traders use it, cost calculation, position sizing, break-even planning. You always buy at the ask. 6. Strict price. Strike price column. What it is, the fixed price where stock will be bought and sold if exercised. Why it matters, this is the decision spine of the option chain. Everything is chosen around strike, ITM, ATM, OTM delta selection risk versus reward probability. How traders use it, directional plays. ATM, slightly OTM, high probability. OTM selling fast move, ATM for gamma. Let's summarize. What have you learned so far? Before we read the complicated numbers in the option chain, you only need to understand 6 things. Which stock this is, how much time the trade has, how many days are left, the price you buy at, the price you sell at, and the strike you're choosing. Once you understand these, the option chain will no longer look confusing. Option chain, the decision metrics layer. 7. Delta. Delta tells you how much the option price will move when the stock moves by $1. It helps you understand how fast your option can make money, and the probability of the trade working. If delta is 0.50, your option will gain about 0.50 when the stock moves $1. Higher delta, faster movement. Lower delta, cheaper but slower movement. 8. Open interest, OI. Open interest is the total number of option contracts that currently exist for that strike. It shows whether traders are active at that level. Higher open interest, better liquidity, easier to enter and exit trades. 9. Volume. Volume shows how many contracts were traded today. It tells you where the action is happening right now. Good volume, tighter prices and faster fills. Tasty Trade shows volume on the chart when you add study instead of on option chain. 10. Out of the money, OTM. OTM percent shows how far the strike price is from the current stock price. Smaller percent, closer to the stock price, moves faster. Bigger percent, cheaper, but needs a bigger move. Think of it like how far your target is from the current price. 11. Implied volatility, IV. Implied volatility shows how much the market expects the stock to move in the future. High IV, options are expensive. Low IV, options are cheaper. IV is the weather forecast for option pricing. 12. Options, layout. Calls side versus put side. Left side, on calls, you make money when price goes up. Right side, ons puts, you make money when price goes down. This helps you instantly match your trade idea with the correct side. Let's summarize. What have you learned so far? Now that you know how to pick the strike and expiration, these next columns help you answer the real question. How fast will this option move? Is there enough activity here? Is this option cheap or expensive? That's what delta, volume, open interest and IV are telling you. Option chain. How to choose the right contract. 13. ATM, at the money. This is the strike closest to the current stock price. ATM options move the fastest, have the best balance of cost and reward, and are the most commonly traded. This is the most responsive option to the stock's movement. Best for beginners, learning momentum trades. 14. ITM, in the money. These strikes already have built-in value. For calls, strike below stock price. For puts, strike above stock price. They are more expensive, move very similar to the stock, and carry lower risk compared to FAR OTM. You are paying more for stability and consistency. 15. OTM, out of the money. These strikes are away from the current stock price and have no intrinsic value. They are cheaper to buy and offer higher percentage profit potential, but they need a bigger move. Low cost means high risk and high reward. 16. Bid-ask spread. Bid-ask spread. This is the difference between the bid price and the ask price. It is your hidden cost in every trade. Small spread equals good liquidity. Large spread makes it harder to enter and exit. Beginner rule, always prefer tight spreads. 17. Liquidity, how easy it is to get in and out. Recognize it by high volume, high open interest, and tight bid-ask spread. Good liquidity means faster fills, fair pricing, and easier exits. Poor liquidity risks getting stuck in trades. 18. Strike. The highlighted strike, your selection line. This is the row you are about to click to enter your trade. This final step brings together direction, speed, cost, and probability. This is your actual position. Let's summarize. What have you learned on this slide? At this stage, the option chain is no longer just data. Now you are using it to choose. Do I want a fast-moving option, a cheaper option, a safer option? That decision is made by selecting ATM, ITM, or OTM, and making sure the liquidity is good. This may seem little advanced from here onwards. You can skip from here and go to next lesson if you want to, once you are familiarized with your platform and trading terminology, and come back later to understand more about the option chain. Option chain, how you actually enter the trade. 19. Mid-price. Mid-price. What it means. This is the price exactly between the bid and the ask. Why it matters to you. This is the fair value zone of the option. How beginners should use it. Instead of paying the full ask, you can try getting filled at the mid to reduce cost, increase profit potential. Simple idea, mid-price, stocks, better deal. 20. Natural price. Natural price. What it means? This is the price you'll get filled at instantly. Buying. At the ask, selling. At the bid. Why it matters to you. It guarantees execution, but gives you a worse price. Beginner tip. Use this only when you must enter or exit quickly. 21. Order type, limit order. Limit orders. What it means. You choose the exact price you want. Why it matters to you. This gives you full control over your entry cost and exit price. Simple rule for beginners, always start with limit orders, not market orders. 22. Order type, market order. Market orders. What it means. You enter the trade instantly at the best available price. Why it matters to you. Fast execution but usually a bad price in options. Beginner warning, market orders can be expensive because option prices move fast. 23. Buying power effect. Buying power effect. What it means. This shows how much money from your account will be used for the trade, why it matters to you. This is how you control position size risk per trade. Simple idea. It tells you, can I afford this trade? 24. Max profit or loss. Max profit or max loss. What it means. For buying options. Max loss. The premium you paid max profit. Unlimited. Call. Or very large. Put. Why it matters to you. Before entering the trade you already know. Worst case scenario. Best case scenario. That's powerful risk control. Let's summarize. What have you learned so far? You don't make money when you analyze. You make money when you get filled at the right price. That's why understanding mid-price, limit orders and buying power is more important than just picking the strike. Option chain, the reality layer, what actually affects your P&L. 25. POP. Probability of profit. This shows the chance of your trade finishing in profit based on current data. It helps you understand, is this a high probability trade or a high reward, high risk trade? Simple example, 70% POP, safer but smaller moves, 30% POP, bigger reward but harder to win. Field and trade panel. 26. Probability of being an ITM. Probability ITM. The chance that the option will expire with real value. It tells you how likely your strike is to be reached. In simple words, how realistic is my target? 27. Break-even price. Break-even price. This is the stock price you need at expiration to avoid losing money. For calls, strike plus premium paid. For puts, strike minus premium paid. This is your real target, not the strike price. 28. Intrinsic value. Intrinsic value. This is the real value the option already has. Example, if a call strike is 170 and stock is at 175, then intrinsic value is $5. This part of the option does not disappear with time. It's the solid portion of your premium. 29. Extrinsic value, time value. This is the extra price you're paying for. Time, volatility, future potential. This is the part that melts every day. This is why options lose value even if price doesn't move. 30. Theta. Theta. Time decay. This shows how much value the option loses every day. Time is always working against option buyers, in favor of option sellers. Simple truth for beginners, if the stock doesn't move fast enough, your option loses value. Let's summarize. What have you learned so far? This is the part most beginners don't understand. You can be right about direction and still lose money, because options are not just about price, they are about time, probability, and expectations. Summary of the lesson. In this lesson, we covered structure layer, ticker, expiration, DTE, bid, ask, strike. Decision data layer, Honsasa, Ardzahnstein. Delta, I4, volume, OI, OTM percent, trade selection layer. ATM, ITM, OTM, liquidity, spread, execution layer. Mid-price, natural price, limit order, buying power, max loss, reality layer. POP, break-even, intrinsic, extrinsic, theta. Now the option chain is no longer a table full of numbers, it is a decision engine. And final note, don't forget to like, share and subscribe to my channel, Net New Universe, so you don't miss the upcoming lessons.